Then I would like to welcome everyone online and in person. Let's see, to tax advantages for savings and retirement, RRSPs, RESPs, and tax-free savings accounts. You're going to learn that in this section, we really love our acronyms. So we are going to go slowly through them so that we don't ABC you to death and you don't catch what the really important stuff is. And, oh yes, thank you. And basically, I am Trevor Davis. I am a chartered professional accountant here in Grand Prairie. I just passed the 25-year mark as a CPA back in January. And then the world changed, but that's okay. Today's hook for this course is, I tried to think of something interesting to keep your attention. But basically, this course is under the heading of, when do I let them bite my cookie? And so let's just get into what I mean from that. But first of all, before you can invest, you need something to invest. And I noticed, I went through what you guys are doing week by week, and I see that by this time in the course, you have worked on a financial plan with goals. I threw in one of my own. You need to earn something. Then you need to spend less than you earn to have something to invest. Budgeting and personal financial statements, October 5th. And now that you have something to invest, you can purchase bonds, mutual funds, stocks, maybe a rental property, according to your own retirement planning. And that's, of course, November 9th, 16th, and the 23rd. So I'm kind of in the middle. Today, when I looked at, sometimes I've given this course and I've tried to cover some of the bonds and mutual funds and stocks before, but I'm not going to do that here today because you've got something happening better than this for the next weeks. But when I see tax and all of these acronyms, I think this isn't really about the investment itself, it's the cookie jar that you put the investment in. So today is about the cookie jar that you put the savings in. You're going to learn about what the cookies are soon in the later weeks coming. So basically, to try and put something that'll stick in your mind, you have three choices. First choice is you can have the government bite your cookie now and every year take a nibble off of the crumbs as they're generated. You can bite the cookie today, choice number 2, have a bite out of the cookie today and never again after that. Or the third option is, bite my cookie later. And then, because I see the word RESP, that's a Registered Education Savings Plan, that's a hybrid of those three choices. That is, bite my cookie today, give some of it back, and take a smaller bite out of my kid's cookie later. That one's maybe not quite as intuitive, but we will get into what that means later. Let's see, if there's any questions, either come in online or from the people who are in person here, I'll write them down and make sure that they get covered at one point or another. But let's just start at the top. So choice number 1 was, bite my cookie now and forevermore. And what that means is you take your investments, you buy bonds, mutual funds, and stocks, and basically they're held in just a regular, we call it just an account, an investing account or something like that, with a retirement planner or a financial institution. And we usually call these things an open account. Corporations can own them, people can own them. And basically what happens is, before you invest, you earn $100, and then the tax man takes a bite out of it, you've got $70 left, and if you didn't spend that in the rest of your budget, you can put that into one of these accounts, buy a mutual fund, a stock, or a bond, and then every year that's hopefully going to generate a little bit of income for you. But every year you get that income, you're going to pay tax on that income. So the government's going to take another little nibble out of all the income that you earn, so long as you are earning income in this account. Basically, you pay the tax before you invest. You pay tax on interest and dividends and rental income annually. And you pay tax on something we call capital gains later when you sell them. Now, quick crash course in capital gains is you buy something low, and a long time later you sell it for a higher price. The difference is a gain. We like to call it a capital gain. So choice, any questions on that one? Alrighty. Choice number 2, bite my cookie today, but never again. And this is when you take that same money, you earn the $100, government takes a bite, there's $70 left. You can put this and buy the same bonds, mutual funds, and stocks, but you can put it in an account called a tax-free savings account. And so basically you'll pay tax before you invest, but then you never pay tax again on this investment. So what happens is you put your 70% of your cookie in, and hopefully it grows, but every time that cookie earns interest or dividends or a capital gain, there's no taxes paid on it. And when you withdraw it, there's no tax on the withdrawal as well. So basically, never pay tax again. In your notes, I kind of put a history of the tax-free savings account, and so I'll just quickly go through that. This is an account that you have at a financial institution, someone trustworthy, and it's registered with the government so that qualifying items contributed to it, like money and qualified investments, can grow tax-free and are tax-free when withdrawn. These things came in 2009, so they're actually not new anymore. They used to be the new thing on the block. Back in 2009, you could put up to $5,000 a year, and they said they were going to index this, and they have. Over the past 11 years, it's now up to $6,000 today that you can put in every year, and this number accumulates over your lifetime. Where you can find your lifetime amount is on your account, my account at Canada Revenue Agency. And you can actually see there's lots of tabs and ways to get around it, but somewhere in that website for you is a spot where it tells you how much you've got or how much you've put in. Actually, that's not it. It tells you how much you can put in. That's a better way of putting it. Next is little technical stuff. When you take money out of this account, say you take $1,000 out of that account in June, on January 1st of the next year, 6 months and a day later, whichever you took out is added to your contribution room for future years. Now, this is kind of a good thing while you're saving and in your working and saving years, because if you had an emergency or something and needed to pull some money out, it's not like you can't replace it in a future year. What this is going to look like as a retirement account is when I'm 70 and I start pulling some of this out, my contribution room is actually going to go up, 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 and up. But I'm not going to be put any more money in because that's the time I'm spending, and it's going to go down, 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 down. But that's neither here nor there. But that's just how it'll work in the end. My own thought was, this is a great place to put our retirement funds if our income is in those lower income tax brackets. Because when we draw on it under today's rules, will not affect the government's social support payments. So that, if we've got any questions, I'll be happy to get into that a little deeper. So that brings us to choice number 3. Bite my cookie later. And that is the Registered Retirement Savings Plan, or the RRSPs. And that's what we keep hearing about in February of every year as banks line up to lend us money so that we can buy one of these things, get a refund and pay the bank off, or not, and grow our retirement with loans. Not sure if I agree with that. On this one, when you earn that $100, in the last 2 ones, I kept saying that the government takes a bite out of this. The mechanism of the RSP, though, is that the government does not take a bite out of this cookie. And so you get to put the whole cookie in, whole $100 in. You earned $100, you can invest the whole $100 in here. And no bite gets taken out for tax. As the cookie grows, makes more cookies, the government doesn't get any bites out of them either. When they get bitten is when you withdraw it out of the plan to spend it. Then you get the bite. So in our fancy land, we call it a deferral. We defer the tax on this to a future year, and the government will get their taxes then. Let's see. So basically, you don't pay tax before you invest. You pay tax when you spend it later. Then next in the notes, I put down some of the technical details of an RRSP. It's basically registered with the government, like one of those tax-free savings accounts, so that qualifying items, cash, and then the cash can buy bonds, mutual funds, and stocks. And these can be used as a tax deduction, grow tax-free, and become income when drawn. This is supposed to be an incentive to save for retirement, and if I'm in a financial course, I say that's what the purpose of this is. That being said, they help out. This account can also be used for two other purposes. So think retirement first. But there's a couple other things you can do with it. There's something out there called a home buyer's plan. You can withdraw up to $35,000 out of your RSP to help you purchase your first home. So but then you have 15 years to repay up to $35,000. However much you took out, you have up to 15 years to repay it. Otherwise, you basically get taxed on that portion that year. So, yes, sir.
So one question I had, and I looked at it quite in detail, is what happens in bankruptcy. And so for instance, if I go out and invest, if I go to a bank and I declare bankruptcy, the government gets to take all that money in bankruptcy. But if I'm clever, I go to a life insurance company, I buy what's called a segregated plan. For instance, I'm in small business or I'm a CPA or a lawyer who worries about lawsuits. By buying into the insurance company, I keep that in a bankruptcy. Then I, at an insurance company, get RRSPs and tax-free savings accounts or their equivalent.
Okay, I don't know if the tax-free savings account is covered in an insurance company, but I have heard that. Hey guys, how's it going? Long time no see, Ed and Jeanette. Am I allowed to say that in the camera? Sorry, guys. I have, the last of the literature I heard is, if you want to bankrupt protect your RSP, you carry it with an insurance company in a segregated fund. So an
insurance company can sell an RRSP.
You betcha. In fact, many of my RSPs are with one of the insurance brokerages in town. It's not an insurance product, though. It's part of their investing arm.
If you're a small businessman or a professional, smart move is to go to the insurance company.
Yep.
Because you get a secondary benefit of you keeping it in bankruptcy due to a lawsuit or whatever.
But not life insurance companies. And I don't know why they did that, but they did. So
I heard that when you get an RRSP and it's a segregated fund, not only is it an investment, but it's partly insurance. It has sort of a minimum cash value, like a type of insurance product. And because it's insurance, it's bankruptcy proof.
Okay. Because it has an insurance component. All right, got to tell you, this is usually farther than I go on these courses, but it's a valid point to add. Insurance content. All right, I'm of course always up here thinking no one's going to declare bankruptcy because they are living within their means, they got a budget, they got a plan, but small businesses sometimes take a turn for the worst and fast. And I've got a couple clients who are thinking of taking everything to the auction because they're kind of tired. I don't think they'll be bankrupt though, but there are people facing bankruptcy, and so that is one maybe component that you want to consider is having, because what I've understood is if you go buy your RSP at like the Royal Bank or Toronto Dominion and that, you go bankrupt, that RSP goes in as part of your estate for the bankruptcy. But you're right, I've heard that certain types of funds at life insurance companies can protect yourself from bankruptcy.
Or I think the other way is assuming you trust your wife, is to put a lot of this in your wife's name.
That's right. Under my details, I've got something called a spousal RSP, and I'll get into that real quick.
She keeps it for you.
Yep. Which means then you have to avoid the other bad word out there, the divorce word. Yeah, don't go through bankruptcy and divorce, you'll lose everything. Just, maybe try and avoid both of them. But
like I forgot to say this last week, and I should have took a class. When you buy a home, if you're a professional or a small business person, you should put the home in the spouse's name that's not in the business or the profession.
Yep.
Because if you do that 3 years before for bankruptcy, they can't touch the home
Yep. And how does a professional get into bankruptcy?
by being sued.
By being sued. We have a $2 million insurance policy against errors and omissions, but we make a $6 million mistake. Oops. Hopefully we never make a $6 million mistake. But that's why I have a short calling list of tax lawyers and other tax accountants, because that's usually the area we get sued in, is if we give bad tax advice. And so we kind of avoid these $6 million lawsuits that way. But I always tell people for bankruptcy protection that a strong business plan and smart business practices are first. The legal contract is second, and the sticking everything in your missus' name is the third. So I'll get back into this a little bit. So we did home buyer's plan and from your RSP. The other thing we can do is something called a lifelong learning plan. I've only seen this happen a couple times practically, but I do know of a couple guys that stopped one career, went back to school, and drew up to $20,000 out of their RSP to fund the education, and then got back in the workforce. The last thing I wanted to touch on was something called a spousal RSP, commonly known as the spousal. Everyone phones me and says, should I buy a spousal this year? Should I buy a spousal this year? And I always have to kind of back them up and say, okay, what are you really asking? Because this is sometimes misunderstood. I usually ask this question in return. Are you saying that you want your wife to buy an RSP so that she has a deduction against her income? Or are you trying to buy an RSP for a deduction against your income, but your missus gets the pension? Are you buying your wife a pension so you get the deduction, she gets the income later? And 3/4 of the time, they want to buy their wife a pension. And 1/4 of the time, they say, oh no, I want my wife to have the deduction, so my spouse is going to buy an RSP. So it gets a little confusing. But basically, all a spousal RSP is, there is me. Chris, is that big enough to kind of show up on camera? Thank you very much. And there is Tammy, my wife. So right now, in Tammy's stage of life, she is a stay-at-home mom and works hard with the kids. So right now, she's not earning an income, so what pension plan is she going to be investing in? But right now, I can buy an RSP or I can put money into an RSP for myself. I can buy myself a pension. Also, I can buy her a pension. So despite the fact she's not earning any money today or out there working, or she's not working as a teacher, not working as a nurse, not working as a doctor, she can have a pension when she retires because I'm buying her one. Aren't I a swell guy? Why would I buy her one? Well, in Canada, we like to do something called income splitting. Each person is a separate person under the eyes of the Tax Act. I file my tax return, she files her tax return. There are links between the two, but they are two separate filings. So someday, someday I retire, if I have all the assets for our retirement, I get taxed on all the income. 100% of the income gets taxed in my hands. But if all these years I've been sharing and generous and doing a wise thing, maybe when I'm retired, I have half the assets and she has half the assets. This 5 is not turning out very well. Teachers make this look easy. Now, I get taxed as I withdraw that. Like I said here, you pay tax when you spend it later. So as we spend mine, I get taxed. As we spend Tammy's, she gets taxed. And now I've achieved, well, we like to call it income splitting. But basically with the way the tax rates go, we'll probably end up paying less tax between the two of us than one together. I saw your hand twitch. You have a question? Okay, it was just a twitch. Yes, sir.
How about the technique of paying your wife
And I'm going to give you the answer I keep getting from all the guys that practice in task. It depends on the facts. If she does zero work for you, right now there's enough rules that you better make it zero. There's some new rules out there. If I try and pay her anything and she honestly does no work for me, though despite the fact that running the kids around keeps me at my desk, despite the fact that doing getting the grocery shopping done keeps me at my desk, I can't pay her a thing. In the old days, you could probably sneak 16 grand, 20 grand over to them. 36,000 was the typical doctor's wife salary since I've been in practice in 1990 and all. But basically, you can pay her as much work as she does. So if she does work, and most of my small businesses, the missus works just as much as the guy, or she works 100% of the job of the banking, the paying the bills, the going to the accountant. So basically, she's 100% of the CFO, Chief Financial Officer position. And so we pay her half. And then we pay the other half to the mister. And he's happy. And so is she.
So what you've got to do is give her some tasks to do.
Yep.
And substantiate why it's worth that money.
That's right.
And there is no limit to what you could do.
That's correct.
A bit of innovation.
Yep. And usually what I find is the clear-cut cases are because you have a trucking company with 80 employees. The mister is there 24 hours a day and the missus is there 25 hours a day. She's usually the one at the office preparing the payroll, paying the taxes, and kind of playing, there's usually one person in the couple that is excellent at defense and one person that's excellent at offense.
But then if she does do that, in a bankruptcy, she's now involved.
Yep.
And you may not be able to hide assets to her, but the bankruptcy lawyer won't pick up on it.
Yep. Yep. That's right. She'll be fully in. So she's getting half. She's taking half the risk as well. Yeah. One thing I always hope, though, is if she's involved, there's less chance of bankruptcy. I've seen that. I have a few client dynamics that the missus is definitely the sober second thought. Not that the mister is dumb, but the mister will take risks. And sometimes the missus goes, you know what, I don't feel so good about that. And then maybe the risk he takes is just a little less, and then they're successful. Let's see, is there anything else here? Yes?
Just on that income splitting note. So I thought that, I didn't think you had to have a spouse RSP to do the income splitting, right? I thought you could split regardless of...
Okay, Alan's got a great point. Something happened. I've actually got here in the notes, new rules for 2007. So this hasn't been around a long time too. I'm telling you, it's nice to have 50-50. I'm going to put this number down, 65. Some new rules came into play where husband and wife can split pension income. And basically, I've got a great computer that tells me how much should be on each. But to do that, you have to be over 65. So point number one, that's a point well taken. The question was, hey, I'm talking that you should kind of have half in your RSPs and half in the missus and try and keep them equal. Well, why do we bother doing that? We're allowed to split pension income when we retire. And I agree. I totally agree. You got to be 65 or over. So if you want to retire though at 55, you got 10 years that you can't split the income yet. Not this type of income anyway. There's another flavor of income, like the teacher's pension or the warehouser pension. Those pensions can be split as soon as you take them. And that's, a lot of people are taking them under 65. Those can. These can't. So for a lot of our private people, they've got RSPs, or they have a corporation too. So I usually recommend doing some of this for this. But once they cross the 65 barrier, yeah, it doesn't matter who takes out the money, and it doesn't matter, well, it does a little bit, but we've got a lot more flexibility at 65 and more. Yeah. Is that kind of clear? I'm not trying to contradict myself, but there's definitely two outcomes here that are both valid. Okay. So one of the questions I asked is, like, when I first started, doing these presentations and talks, I realized I'm kind of young and I'm in the putting in part. So you just put it in and you put it in and you put it in and you don't touch it because it's supposed to be for retirement. What are you supposed to do when you take it out? And basically, I thought, yeah, what does happen when you take it out? I'm piling this up. What do you do? So at the bottom of page 3, I say, what to do at age 71. Now, you can do this earlier, but age 71 is kind of the last year you can hold on to these things before you have to start taking them out and pay the tax. And basically, at age 71, that is the last calendar year you have to make a contribution to your RSP. Your deadline is December 31st. Up until that point, your deadline is February of the next year, because the government likes to give you a chance to see what you earned that year and have 2 months to figure out whether you want to put in a little extra for the year before. It's kind of nice of them. Doesn't work when you turn 71. If you turn 71 on December 29th, you've got 2 days to put in your last RSP. If you turn 71 on January 2nd, you got 364 days, or 363, depending if it's a leap year or not. At that point, on December 31st, you have 3 things you can do. Cash it in and pay the tax. I don't recommend that. You can buy an annuity for life from a life insurance company. And basically what you're doing is you're hoping that you accumulate a big pile of money and you're buying a pension plan. You go to an insurance company and they say, well, if you give me $1 million, I'll give you $5,000 a month for the rest of your life. Or maybe they'll give you $6,000 a month for the rest of your life. And if you get hit by a bus tomorrow, they keep all your money. Or you go to the insurance company, you say, I'll give you my $1 million, and they'll give you $4,000 for the rest of your life, guaranteed for 10 years, and after that, we'll pay your wife half if you get hit by a bus. It's like, okay. Gets complicated at that point, but basically that's one of your choices. And the other one is to take your cash, or take your pot, and then it moves into something they call a Registered Retirement Income Fund, or a RIF. And remember what I said at the beginning, they love their acronyms. So a RIF, you'll hear old people talk about it. I got to draw down on my RIF. Remember that when we first put into the RSP, we don't pay the tax until we spend it later. But what that doesn't mean is that we keep it in there, and if we never spend it, they never get their hands on it. From the age of 72 and on, you're required to take out a minimum amount each year, so that about 90-ish, maybe 95-ish, it's totally drained. Give or take. The percentages have changed over the years. Back when I first started, it was like 1/20th, 1/19th, 1/18th, 1/17th, 1/16th, all the way down to 1/2 and 1. So basically it was drained out over 20 years. Yes, sir?
So you elect to do that.
Mm-hmm.
You got it all figured out. You're going to go to your 95.
Hopefully.
You die when you're 80.
Yes.
Does that mean the estate now has RRSP money, but the government must be paid tax by the person handling the estate, the executor, prior to distributing it?
Absolutely. Unless you have a spouse that you have named beneficiary of that, or a disabled child. I believe we can also do a disabled child. Let's see, I know there's lots of people in different life circumstances. I'm probably going to die before my wife Tammy. When I pass away, my RSPs, my RIFs, all shift to her without the government taking a bite. When she dies, the government takes a bite. Unless she gets remarried and leaves everything to the next guy. But, I don't like the thought of that. Not very much at all. But, what Jeff said was, yeah, this happened. I had a fellow who was never married, worked for the government, had a government pension, worked for subcontracting through like defense and stuff like that. And when he passed away, he had $250,000 in RSPs and that he had saved up for his retirement, and he got a pension payout of like $350,000. That was $600,000 of income on his final return. We cranked out a check for $250,000 and his siblings got the rest. Ouch. But he would have had a good retirement except for the interrupter out there, cancer. So that is correct. You pass away and all that money is taxed then. You pay the tax later and that's when it happens. Okay, any other questions? Alrighty.
The RIF means that you're not going to pay all taxes when it ends at age 71.
That's correct.
You can put it into RIF and pay a bit each year.
That's correct. And you pay a bit each year as you go until the account is drained. Yeah.
On that tax thing, so here you are, you die on June the 1st,
Mm-hmm.
and you pay taxes at the end of the year, and then it's all in stocks and mutual funds, which of course the value of those go up and down.
Uh-huh.
So what amounts, or what's the tax date? Is it on the day of death that they do the deemed disposition, or how do they figure that?
And that is the answer. So, check out date. COD, checkout date. June 1st. That is what the government says. You are deemed to have disposed everything at fair market value at that date. When we say deemed to have disposed, that's one of our fancy words for you sold everything even though you didn't. Because everything from here gets dealt with in accordance with your will. But basically at this point, yeah, we could have stocks going up and down, 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 and up and down, and finally you've sold them and taken care of the estate. This little point here, wherever those stocks and bonds, mutual funds were as of that date, whether it was in your open account, your tax-free savings account, or though you're not going to pay taxes on the tax-free savings account, or the RSP, that's the date.
You better hope your stocks don't take a big dive before you.
Yeah. Now, here's the excepts. For you, except for Sheena. We almost don't care, because I'm hoping your will says everything to Sheena. We don't care what this is, because she just inherits it at whatever your old cost was and carries on. But yep, I don't know how many times I've called the investment advisor up and said, hey, can you give me, the fellow died on August 25th. If you've got an investment statement that says August 31st, that'd be really helpful. Unless the guy can actually pull one from exactly August 25th, we get close and away we go. Now, what happens though is between here and the time you actually cash it out, you could have a gain or you could have a loss. And there are some fancy tax stuff I can do. If you have a loss here, I can actually, say we had a capital gain. Cost was $100. We died and it was $1,000. So I have a $900 gain. But it takes a while to get through my estate. And there was a market crash after I died, and all they got out of it was $900. Well, in the estate, I died. I bought it for $100 and died at $1,000. I got a $900 gain. The estate's cost is $1,000 because that's what your estate bought it for, is whatever you sold it for to them when you died. And if they only sold it for $9, I've got a $100 loss. And so long as I file this within 1 year of your passing, we can take that $100 loss and offset that $900 gain so that on your final return, I only have to put $800 of a gain. And that makes sense because I bought it for $100 and I got cash, my estate got cash of $9. Someone should pay the tax, the difference, but you're not penalized if you do it within the first year. But that's usually beyond what I get into, but that would be what a good tax advisor is telling your executor. Yes, sir, Jeff.
For tax purposes, is it where you died or the residency of the province you were in?
On the date of your passing, it's considered where you reside and not necessarily where you died. So if you died in Cuba, good for you, but you left your house in Alberta, your house is in Alberta, your bank account's in Alberta, your vehicle is registered in Alberta, your RSPs are in a financial institution somewhere in Alberta, your address is in Alberta, the house they're selling is in Alberta. That's a really simple case. You're an Albertan, and it doesn't matter where you die. Your final tax return is filed as an Alberta tax return. Now, here's the cute part. If your executor is in BC, it's a good chance that your estate is a BC entity, not a Alberta entity, even though all your assets might be in Alberta. If you have an estate guy come in, have them verify that, but that's my understanding. I've had to watch when I have an executor who lives in Richmond, BC, acting for someone in Alberta. First of all, they have to get a local lawyer in BC to talk with an Alberta lawyer on the estate and make sure everything gets handled properly. But at the end of the day, when I file that estate return for gains and losses, I think it's taxed in BC. So there can be little complications like that, but that's a pretty complicated thing. It's kind of more, it is realistic, as a lot of people like to move away when they retire, and go to warmer weather places, but.
I heard in the States, there's sometimes where it's convenient to move the body.
Usually 6 feet under is the best spot for it, but yeah, or at least move the executor. Like if the executor refuses it, and then the court in Alberta appoints an executor in Alberta, then you have a lot less complications. Or, I do believe we have a U.S. citizen in the room. Do we? Yes. Yeah. What if our U.S. citizen is the executrix of an estate? Ooh, I didn't want to touch that tax return, because there's I sometimes call the story. Anyone here heard the story of the three billy goats gruff? There's the little one who gets across, there's the middle one who gets across, and then there's the real big nasty one that butts the troll off the bridge. Yeah, the big one's the IRS, the little one's the Canada Revenue Agency. And there's my step into practicing U.S. tax, and that's as far as I'm going. They have, there's 50 states, a couple territories, and the feds too. That's a complicated tax system. If you have a situation where you have a non-resident that's in your will as your executor, you may want to change that. Or you will be paying good fees to good lawyers at big international law firms to make sure it gets done right. That's your second thing. It's either expensive or easy. All right, any other questions? This is good because I need to know, you present material thinking this is what people want to know, but then when people ask questions, then you find out what they really want to know. Let's see, so we've found out what to do with age 71 once we've added up our stuff. Now, this isn't necessarily retirement here, but there is tax advantages to savings and investment in also something called a registered education savings plan. So this is a bit of a hybrid. What happens here is, so remember, an open account, the government bites the cookie before it goes in, and then the government bites all the growth of the cookies every year until you stop. The tax-free savings account is the government bites the cookie, but then doesn't bite any of the gains after that until you spend it. And then you don't get it bit when you spend. And then RSP, the government does not bite your cookie today. You get to put the whole cookie in, but when you take it out, the government takes their bite then. Registered Education Savings Plan is a bit of a hybrid of both. It is designed to put your kid in school. And when I say school, that is accredited institutions. Accredited institutions. A lot of people say, yeah, this is the kid's college fund, university, college. Makes it sound like it's an academic thing only. This is trade school. This is Fairview Community College. This is NAIT, SAIT, U of A, Peace River Bible Institute, Alberta Bible College. If it's an accredited institution, you can send your kid there, and this money can be used to send them. People who can contribute. You know, I didn't put that there because I just think, oh, it's just the parents. Grandparents can contribute on the behalf of grandchildren. You know, because I think there's a few grandparents in the room. So long as they should let the parents know that they're doing this, though, because there are a few maximums. If you've got a parent who's gung-ho and putting the money in, and you've got a grandparent who's gung-ho putting the money in, they should communicate. Basically, there's a, oh good, you guys have a handout. The government will match, if you put $2,500 in for a year for a kid, the government will add $500 to that. So now there's $3,000 in there to invest. So in my mind, in year one, you earn 20%. And that's a guaranteed investment of 20% in the first year. After that, you can kind of go along at 5 and 6%, but you've made some good money. These $500, though, maximum lifetime of $7,200. And so you need to contribute $3,600 to get the maximum grant. And that takes a couple of years. That's not something you do in kind of 3 years leading up to the time they run away to university. This is something you want to start when they're little. And then, of course, you need to give them lots of propaganda that they're going to go to school. And of course, you know, with my son, I've told him, hey, you're going to school. And it could be for a welder like your uncle. It could be an electrician like your uncle. It could be an accountant like your dad. It could be a lawyer like one of the good guys here at church. It could be a Bible school. Maybe you're going to be a pastor. Really? Chris, I think he wants to be like you. I think he likes computers and tech. So I'm going to send him to NAIT, or he's going to go to NAIT or SAIT or U of A, U of C, and we'll see what he does. But, you know, definitely trying to mold that mind to go that way as opposed to, I want to be in a business where I don't need any education. Okay. But the good news is he's got till 25 years of age to get it spent. So if you have a lost 18-year-old who wants to be a gas attendant, that the gas attendant doesn't need a degree from a university, he can be a gas attendant for a while. Just then maybe hit him upside the head when he's 21 and get him into school fast. You also see here, to get your full grant, if you're only allowed to get a match in the first $2,500, $500 is the grant, and you need $72,000, or you get $7,200 max. It takes you about 14 and a half years to max out the grant. So it's good to start them when they're 3 or 0. To be blunt, we started my daughter at 0. She'll be maxed out in 3 years. My son, he'll be maxed out in 3 years because we didn't start him at 0. Let's see. There are extra grants if your family net income is lower, but that's a matter of, you know, that's a pretty individual thing. If you are in that situation, the financial advisor will know, and you'll get those extra grants. Now, the government took a bite of the cookie, but then added 20% back. So if you earned $100 and the government bid it and it's down to, what did I think, 70, and you put that 70 in and they match it with 20%, I think there's 84 in there now. So that's okay, you got $84 in there, and it grows tax-free. So it's a little bit like the RSP and the tax-free savings account. It grows tax-free, and then when you take the amounts out, your child goes to school. The money that you put in, the $2,500, the cookie was bitten on that. So when that money comes out, there's no taxes on that. It comes out in the kid's hands, though, for him to spend in school. All the income and the grants that it earned, that gets paid to the student, and they pay tax on that. That's an okay thing, because they're paying tuition and getting the tuition credit. And their income is a little lower because they're going to school full-time and maybe only working a part-time job, or maybe only working full-time in the summer. So the nibble, it's not so much of a bite, but a nibble. And then if the child, so that's what happens. Basically, they get your contributions out tax-free, and any money it's earned, they get taxed on over 4 years, and that keeps them going through school. Hopefully you've paid, tuition, maybe some of the room and board. If the child does not go to school, you, depending on your plan, you could get your contributions back, but you lose all the income you could have earned over the past 15 years, and Yeah, you might lose all the income you earned, and yeah, basically, you just get your original $36,000 back, or however much you put in. The income may be able to pay it into your RSP, depending on the plan, so that's a good thing. But you have to have enough room for it. Now, for a lot of people, that's not a problem. If you get all of the money back, you get to pay tax yourself on it, chomp, and an additional 20% tax on top of that, chomp, because they didn't get their little nibbles for the past 15 years. They take a bigger chunk out of the end. So someone at a modest rate of 30% or 36% pays 50 to 56% on this RESP income if their kid doesn't go to school. Ouch! I don't believe you get the grants. The grants just kind of get returned to the government, or quite often these plans are kind of a pooled or a group plan, and the group keeps them and pays them out to students that are going. So that all depends on the plan you're in. And so if you are setting these things up, take this and ask the questions. If my kid does not go to school, what happens? And then be educated on it. And they might say, well, plan number 1, this happens. Plan number 2, this happens. Then make your choice, and you get to live with it. But ask the question. So any questions on a Registered Education Savings Plan, or RESPs? Yes, sir?
I was looking at RRSP. One thing I like, I get to deduct it from my income tax.
Yes.
So there's a good benefit there. My understanding is the RESP, I can't do that.
That's correct. That's the Bite My Cookie now. You have $100. You do not get a deduction to save for your kid's future. You lose the 30% to tax, you got 70% of a cookie, it goes in, and then they add 20% of the cookie back under a grant, and then it grows tax-free from there. But yeah, it's not a deduction. The RSP is lovely. You put the whole cookie in to grow.
So therefore, you should do RRSP first. Then if you have extra savings, consider RESP.
Yep, I have seen that philosophy. That you take care of your own retirement first before you take care of your kid's retirement. The philosophy there being, your kid might not support you in your retirement, you better support yourself. Especially if you don't pony up for his education. No, just kidding. If all your money goes to living, because we're going to assume that you're going to keep a debt-free lifestyle, but it goes for living, keeping the lights on, keeping people fed, you've got an emergency fund, and you're funding your retirement. If your money stops there, so do you. If you have extra, then maybe you pay off your mortgage early or put into a child's education, because if and many people are out there, mom and dad either didn't plan or didn't have enough to plan. Whichever case, you might have to do a 4-letter word to get through school, and that's called work. Co-op programs, maybe it'll take you 6 years to get through. If the education's valuable to you and you're driven, you can work your way through. And it's not going to be easy. Tell you the truth, I don't want someone with an RESP to have it too easy too, because I think they should pay for some to have some skin in the game, so that they have some efforts going to this, and then they're not just kind of going on a free ride and might waste the time. Yeah.
For my son, I can say I'm going to go to university, but I can't say you must take accounting or you don't get anything.
That's correct. As far as I know.
So they can take a horrible arts degree.
They can take a horrible arts degree. Shh. They might become the choir guy. No, just kidding. Yep. We're hoping that the education leads to something, but it'll be the character of the student. Let's see. Anything else?
So
yes, Ed.
in the RESP, the money, does that also go into stocks or mutual funds or whatever and grows?
Yes.
Okay.
Yeah, it is the same type of investments as what you can put in a RIF or an RSP, Registered Retirement Savings Plan. 71K? No. Oh, what do they call them in the States? 401K. The 401k, that is the name, that is the paragraph under the Tax Act that says what you can do, or the tax code that you can do. Here, it's under Section 70, don't you know? But instead of throwing 70 at you, age 70 is when you should retire, Section 70, they throw an acronym on it to make it good and confusing. Or do you throw sections of the Act? Then there's the IRAs and the Roth IRAs, and they all probably quack a little different. I bet you they're all good to get into, though, if you're trying to save for retirement. So, and again, there's my limit of U.S. tax practice. All right. Any other questions? Okay. I threw on a couple little bonus things that weren't necessarily part of the title of tax advantages to savings and investment, RRSPs, RESPs, and tax-free savings accounts. I threw in another one here. There's something called a registered disability savings plan. Now, I don't put too much down there because things have changed. I don't really not so sure of the rules because I've never had to help anyone into one of these things. If someone asks me about them, I send them to a financial advisor that knows what they're doing. But basically, if you have a person who is disabled, like a disabled child, a disabled child or a disabled family member, you can put money in and it's matched with grants depending on your income or the family income, and then it grows tax-free, and the disabled person can take it out to help with their living, and I'm not sure how the tax works there. Maybe they pay taxes on it, maybe they don't, but it's still meant to be your part of their care plan for them. And I'm thinking the way it was designed was, you're older than they are, you put money into this, and when you die, it's there to support them when they're 40 years old and they're unable to support themselves. So my thing to you is, I want you to know that they exist, and if you have a disabled person to take care of, I want you to look into them and maybe see if that's part of your financial plan. The next bonus is donations, charitable giving. Since we are in church, I always like to throw the tax aspects of that too. I'm not sure if you've covered those under any other part of the courses. I look at this and I understand it, but there's a lot of jargon in here. But basically, one of the things that the government likes to do is it likes to write things into the Tax Act to encourage us to act in certain ways. So we get these deductions for RRSPs, and we get these tax advantages of putting money into a tax-free savings account or our registered education savings plan. That's because they want people to save for their retirement so that we're not all knocking on their door when we're retired. And they want our kids to have some education money so that we're not knocking on their door when our kids want to go to school. Another thing they want us to do is actually give to charities, like the Grand Prairie Church of Christ. And what they do is, if you give money, they knock some off of, if you owe taxes, they take some money off of that. So first of all, for a donation to be any tax advantage and not just spiritual advantage, you have to be owing some tax. So assumption number one, you owe some tax. If you give $200 in a year, you will get $50 of that off of your tax bill. The next dollar and up, above $200, they will give you 50% of that back between the province and the federal government. If you give, you give $200 to the church in January, and in February you give another $200. That second $200 is going to take $100 off of your tax bill next year. And so sometimes when I've been up and in front of a crowd, I say, let's do some math. And I say, so if I give the church $1,000, and let's assume that it's above this 200, how much do I get back in taxes? If I give the church $1,000, I get back 50%, which is 500. Okay, so if I gave the church $1,000 and I get $500 back in my taxes, how much did that cost me? Amen, brother. Right, because you're not trying to make money out of your tithe. Okay, spoil sport. It costs you $500. And then you get to be generous again. So if it cost you $500 and the church got $1,000, where did the other $500 come from? The guy with the real cool hair. Our lovely government just subsidized the church. It took you $500, but you added $500 of the money that the government was going to get for you and put that to where you wanted it spent. So you're taking government money away and putting it where you want it spent, whether it's the Grand Prairie Church of Christ, SPCA, what's some of my favorite ones out there? The Moolies, all sorts of good charities out there. Make sure they're a registered one in good standing. And so that's my basic talk on that. I put down some other jargon here, that you guys can read on your own. I get a little confusing. I got all excited and got mathy here. So is there any questions on that? Okay. Yes, sir.
Is there a maximum per year?
Aha. Is there a maximum you can give away? And the word is 75%. In a corporation, it's 75% of your income is the max. For personal, once you've given so much that you're not paying zero taxes, then you're allowed to carry that donation ahead 5 years. And if you can't use it in 5 years, it drops off the table. And it's never been used for tax purpose. And that actually happens to seniors because they aren't giving out of their income anymore, they're giving out of their capital. And I've got a couple seniors that I work, I say, are you selling the farm this year? It'd be a really good year to sell the farm because the taxes you pay are already paid by your donations for the past 5 years. Yeah. Most people don't have that problem though, where they're giving more than they get back, but unfortunately. Any other questions? Because I want to do some math. Alrighty. Now, one of the title of this course is the advantages to savings investment, RSPs, and tax-free savings account. And so remember at the beginning, let's see, I defined an open account. So bite now and always. An open account. So that's just you following your budget. You got some money, you invest it. And the government taxes you as you invest and taxes all the earnings on that investment as it goes. And at the end of the day, you spend the money, it's been taxed. It's all okay. Bite now. The second choice was bite now, then never again. Is this somewhat clear, Chris? Okay, thank you. And that's the tax-free savings account. And remember, we love our acronyms. So if I am talking too much acronyms, stop me, and I will do proper words. But it's also in your notes. And then choice number 3, bite later. Okay, and that's the RRSP. Now, this is the growth part. I sent out in the email and that a little spreadsheet that you can play with. And maybe don't play with it yet, because I want to surprise you first. And Mr. Jones, the password is on. Or is there no password and I can just hit? Okay, just hit enter. All righty. So, let's see. What I need, I'm going to say you invested $100, and the reason I earn $100 in 1 year, and the reason I use $100 is so that those who think in percentages can see some percentages. Now, the tax brackets, first tax brackets around here are 15, 25, 30.5, and 36%. Someone give me a good tax number. Which tax percentage do you guys want me to work with? Second highest, 36. So tax rate of 36%. And then we want a rate of return. Now, I'm sure you're going to get into that with bonds, mortgages, and whatever, but now let's just express this at a percent. And the basics is, the higher the percentage return you're hoping for, the higher risk you're taking. So I'm going to just start at, give me a rate of return. 6. I like 6 because it allows me to change it upwards a little bit and show the difference. So in year 1, if I earn $100, I paid 36%. I'm actually going to plunk that here, even though I should be able to do year 1. What do you know? Those are what I had on my spreadsheet. In year 1, I'm investing $64 because I had $100, paid $36, I have $64 left. That's in the open account. The tax-free savings account in year 1, well, as I said, they bite you now. There's no tax deduction, so you have to pay the tax on the money when it goes in. So there's $64 going in. Over here, though, in the RSP, you get to invest the whole $100. All right, doesn't look too significant yet. It's only 36 bucks.
So what are we doing? We're investing $100?
Yep, $100 in a year.
So what's the $1,100?
The 1100, unfortunately, is a dollar sign. My bad. Yeah, boy, the government ate a lot of that cookie before it got in. So we have $100, tax. Okay, at the end of the year, $64 has made 6%, but you've had to pay $36 or 36% of that 6%. You have $66.46 at the end of the year. Yay! It grew. In the tax-free savings account, it earned 6%, but the government doesn't take their bite. There's $67.84 in there. And in the RSP, my math better say 106. Good, it does. I know my table is working. $106. Well, Trevor, that's sure not much of a difference here after 1 year. I think this is a load of bunk, and I'm not going to do this. That's what some people do. Where's all this money? Well, let's go to year 5. This is when people give up. So 5 years later, you have invested another $100. You've paid or you've earned another $100 every year. You've paid tax at 36%, and you've put the $64 in here every year for 5 years, and it's earned 6%, and it's had little nibblies of tax taken off of that. After 5 years, there's $359. 359, oops, writing.
Is the interest compounding?
Yep, I am compounding the interest too. Yeah. So if you think about it, I'm earning $100 a year that I'm investing. I've got 359%, or 3.59 times. That's pretty good, or it's getting there. A lot of people give up at this point because they're not seeing those huge gains yet. Year 5 over here, they're not taking, you're always putting in the $64. There's $382. 382. Not much of a difference, but it is bigger. And in year 5 over here, $597. Okay. Definitely see why a lot of people will prefer an RSP, because economically I've had more to put in, and the government hasn't been taking any bites out of it. This is okay. This is when a lot of people give up because they're thinking, I'm putting all this money away for retirement. There's nothing there. I could be doing better things. Let's jump ahead to year 25. Okay, so you've been doing this over and over and over and over again. There's now $2,709 here, give or take. Compounding, earning, putting in a little bit in, growing every year, and paying tax on the growth. 25 years. Now, this sounds good. I'm earning $100 a year. I've put $2,500 in. Or no, I haven't put $2,500 in. I've earned $2,500. And there's $2,700 left. So I've got more than I earned and put in. 25 years on the tax-free savings account. 37 22. Not very big numbers yet, are we? But there's $1,000 extra here after 25 years. That doesn't sound like much. I'm going to go one more over here, 25 years. In this one, 58.15. Dollars. Now we're talking. This is almost double that. Or it's more than double that, isn't it? 5,400, it's double in your RSP. Now, these numbers are really small, Trev. Let's change this number here to 1,000 a year. I'm hoping the math will be very easy on this. $27,087. Yep. Okay. All I have to do is add a 0 onto all of these. And $100,000 a year, 25 years, there's $27,000 there. There's $37,000 here, and there's $58,000 here.
So Trevor, are you putting in, so for instance, in 5 years, you're putting in $1,000 each year? Is that what you're doing now?
Yep. Though in this instance, I earned the $1,000, I lose $360, I've got $640.
But you're always putting in money every year.
Yep.
And then even on the RSP over here,
I am.
put in $1,000 every year.
Yep.
25 times you've done that.
Yep.
Okay.
And here I've got $25,000 my own money and $28,000 of someone else. No, 50. I got $33,000 of someone else's money in there.
So your basic point is RRSP is a wonderful savings investment account.
Yep. It grows the biggest.
You really do well because you're tax sheltered.
Yep.
But then they still have to take their bite.
Yep. They take the bite later. Now, if it's a 36% bite later, 36% or 60, that'll leave you with 64% of this. That times 64% is that number. But
figured out how to tax shelter it forever. So what you do is the guy who's got that dies.
Mhm.
He marries a younger husband.
Yes.
After she dies,
He leaves it
and
to
then
him,
he marries a younger
wife,
wife.
and gives
and
it
they
to
just keep
her.
doing that, and they never pay anything.
Yep, it's a good scheme if you got, like, make sure you're not marrying your relatives, because that gets weird. But,
Well, you can do that in both.
yeah, whoa. Here's one thing I also want to show. So I've done 25 years. I'm going to do, for sake, it's $1,000 a year for 40 years. And why do I pick 40? Because 25 years old, hopefully I'm done my education at that point. Unless you go back for a second career, that's okay, that's okay. But what if I enter the workforce in earnest at 25 and I work till I'm 65, and that's 40 years? And I put $40,000 in. Here we go. There's $60,000 here. 60,820 under the tax-free savings account. There's $105,000. After 40 years. And under the RSP, there's $164,000. Woo! Now, imagine if you were doing $3,000 a year, $250 a month. Triple that under these circumstances. Triple of 164. What's that, 5-some? 580, give or take. Now, time is your friend. If you are young, time is your enemy if you're middle-aged. The best time to start is now, or the second best time to start is now. The best time to start was then. But sometimes this is a growth thing, and we grow into this. I was fortunate enough to have my mother after a year I was working, she says, have you put anything into your RSP? That's important. And I went, oh gosh, I heard about this putting into RSP, but I guess you have to actually kind of do it to get it in there. So, you know, I opened up my RSP with a whole, I think I had $600 in a savings account, and I started it. It was a good step. It's higher than 600 now.
So the average bird there you know, it's another 65, and they have the CPP, and they have the OAS, and they have the $169,000 in RSP.
If they only put.
Would they be, would you guess?
Very good question. So the CPP, it maxes out at about $12,000 nowadays, give or take. The old age security is about $775, let's say $8. If they have no other savings, no other income in retirement, that's $20,000. That tax bracket, the first, well, provincially is a little different than federally, but you didn't even pay tax on most of that. About, say, the first $15,000, you didn't really pay much tax. So you only paid tax on the last $5,000, and it's at maybe 25% on the last $5,000. So you paid $1,200. To take out this 164, if you had to do, like I'm going to go under the oldest rules. That was 1/20th. That was 5% of it. It's different, but if you had to take 5% of 164, that's $8,200. I think that's about right. So you are at 28,200. You're still in the lowest bracket there, 25%. So you've saved it at 36 and you are spending it at 25. That's what some people try and sell these things on too. Is right now you're earning and you're making more income with your earnings, so you should save at 36%. But when you take this stuff out, maybe your income will be lower because you're not working anymore, and so you saved 36 cents 40 years ago and you're only paying 25 cents today. That's not necessarily a bad thing.
Split it with your wife.
Yeah, and this can be split with the missus. Remember her with the hair? Pretty hair.
And you haven't even included the tax deduction of the RRSP against tax that you can do every year.
Yep. Well, actually, no, I did, because that's how I have $100 to invest here versus the 64. I have taken the tax advantage into effect as I've gone.
Okay.
Yeah. Now, some people are probably looking at this saying, great, I'm retiring. It's $1,000 a year at 6%. I get $164,000. That's not a very big number to retire on. For one thing, if you are working a plan, staying employed, or working a business for a living and spending less than you earn, you're kind of arriving at the finish line with a paid off house, so no mortgage payments, hopefully some paid off vehicles, so no car payments. You want to do stuff, but you've been saving and doing, or you save to do, or you got some good spending habits. You make sure you go and do some stuff. But that number's probably bigger, or that number kind of covers a lot of extra living on top of it. And a lot of people give more than $1,000. If we up that to 10,000, this is 1.64 million. Now, that maybe is a little unreasonable or unrealistic for many people. But think about some people on the pension plans, like say the teachers, the nurses, government workers, and they're seeing like $250 a paycheck disappearing, to these pensions. Well, that's $1,000 a month, a little bit more than that. And then they get a guaranteed income for the rest of their life. And that's not a bad thing. Kind of risk-free too, because that's what the contract they signed. One thing I wanted to do here is show the other difference. So we were doing a very modest return at 6%. I'm just going to inch that up to 8. So I'm going to change that to 8. And to be all dramatic, if you could find 2 measly percent more, we jump from $60,000, let's see, to $83,000. Wow. That's an extra 25% extra on the bottom, or sorry, 33% extra, an extra third on the bottom. under the tax-free savings account. If I could get 8 instead of 6, that 105 turns into 180. And the RSP is 280. So I put it here because this is the most dramatic side of it, for sure. That is time working in your favor, the tax stayed the same, and you managed to squeeze 2% more out of your investments, and the jump in 2% is quite a bit. Now, sometimes I start at 4%, it makes the jump look even bigger. Play around with the spreadsheet. I tried to, okay, I'm not a spreadsheet designer builder. You know, if you go and mess with the second tab, you're going to mess up all of the calculations. But if you can just put in your own tax rates, 25, 30 and a half, 36, put in your own return rate that you're trying to get to, and then put in your own amount. Many times people start out with $1,200 in a year. You know, $100 a month. Going from $1,000 to $1,200 in a year, this jumps up to $500. So that tells me that my math is a little weird. No, $1,200. No, sorry, that was 5 more years. Jumps up to $335. So $200 a year divided by $5 Starbucks coffees. Don't mean to pick on Starbucks, but I think you should drink Starbucks coffee after you've maxed out your RSP, not before. Or after you followed your financial plan and paid for your retirement, then buy a Starbucks. But let's see, $200 divided by 5. How many coffees is that? Oh man, it's the end of the day. 40? That makes sense. 40. Yeah, 40 coffees, and we go from 280 to 335. So 40 coffees a year costs you, oh gosh, $55,000. If you're not doing it in the right order. If you're saving for your retirement and then buying the coffees, and it used to be the muffins got the bad rap, but people, you know, muffins are too high in fat, and besides that, did not have caffeine in them, so we didn't get addicted to muffins. So we do $5 coffees instead of $5 muffins. Alrighty. Any questions on that arise from this table? There was one that I had that lots of people like to ask. Ed.
This is an impossible question. But, because with the economy just being a little bit tougher right now,
Yep.
and there's doing a lot of spending, there's a possibility of new taxes coming in. In your opinion, would there be one, like between the TFSA and the RRSP, that would be safer, like more likely to get tax problems later down the road, where they change the tax code?
Okay. Generally for taxes, tax purposes later, this one's worse. The reason we want more is because you're going to get less support. So I'm going to tackle your question one way, and then you're going to ask me the question again, and I'm going to probably tackle it a different way. Okay. One of the big, because sometimes I answer the question I think you're asking, not the question you're asking. One of the big debates out there is, if I take out this 180,000 instead of this 280, it's going to look like I only have CPP of 12 and old age security of 8, and I've got $20,000. And when the government looks at you and says you have $20,000 of income, they think you need support, and then they give you guaranteed income supplements. They give, like, there's all sorts of extra monies out there for old people who are poor because we don't want them to starve. So that's a good thing, but it's all income based. So in this scenario here, you have $180,000 that's never going to get taxed. So you take that 180 out, you can be taking out $8,000 a year to supplement yourself, but as far as the government is concerned, you only got 20, so they'll give you $3,000 in supplements to bump you up. This guy here is going to have the same $8,000 after he pays the taxes on it, but he isn't going to get the $3,000. So that's one of the things, a lot of people like to go here first. So that's one way. But what if they change the rules? Well, not changing the rules, this one's last year when you are retired. My philosophy, though, is if I've got $500,000 of this, I don't want their guaranteed income supplement. I don't want to be worrying about every time they raise my property taxes because I don't get enough out of my pensions, out of the government pensions, to keep up with how they're raising property taxes in Grand Prairie or Calgary or Edmonton or Vancouver. I don't want to be in the position that the government is supporting me, because I've known people that are supported by the government, and quite often there's resentment and fear, because what if the government changes something? And when they're changing something that's my livelihood, people are scared. I'm not knocking the fact that some people need help, and the government offers that help, and it comes. I think, though, in the long term, though, there's going to be fear and resentment there, not gratitude and thanks for the help when I needed it. Now, does that help a little bit?
Well, yeah.
Okay, now I'm going to answer it a different way. If they change the rules, all this is out the window. They could say, remember these old tax-free savings accounts? In general, there's legal precedent, or I'm not a lawyer, but I've heard a tax lawyer say that the government's not allowed to kind of go back and tax something that they already said was good. So it could be that 25 years from now, they'll say, no more tax-free savings accounts, no one can put any more in. If you maxed out your lifetime, you're done, and maybe you can, we'll let you max out what you said you could put in over the next 10 years, and that's it. We don't want this growing anymore, because we want you over here so we can get our tax dollars every year. They could do that, but they usually don't go, you've got this, we're taking half. Same thing with an RSP. They could say, well, people got too much money in RSP. We need to tax all the earnings on that every year. They could change the rule. They could change the rules and do that, but there's a lot of precedence in that they can't say, and half of that 164 is ours. Now, if they do start doing that, I'll be in the States somewhere. Is Miami nice? Yes. I will be in Miami with every other Torontonian and East Coast Canadians, because they head to Florida. Maybe I'll be in California. Or maybe I'll be in Wyoming. They don't have state tax. So I've heard. And there's lots of room to hide. Home on the range. That's another reason, too. A couple years ago, there was a couple proposed changes to the Tax Act that when you read them individually, they were designed because they thought that there was some shenanigans going on with tax planners kind of twisting things up. And they tried to solve one problem here and one problem there, but what we think they had was two committees working on their own to solve two separate problems. When you stuck those proposals in the Tax Act and read them together, it basically meant every dollar coming out of your company would be taxed, including if you put money in as a loan and took that loan out, they would tax you. And that doesn't make sense. You put money that you earned in, or a bank loaned you money, and you paid that out to the bank, well, that might be taxable to them, like the whole amount. It was really weird. There was quite an uproar. They realized the error of their ways, and they removed them. They've come up with a couple other rules since, but they were just ill thought out of, and it scared the crap out of a few. And the tax lawyer that was teaching us what they had almost done before they rescinded, saying, tomorrow I'm going back to the office and we're helping a billionaire get out of Canada. So when they muck around with taxes too much, the tax tail starts wagging the dog and the dogs leave. Even though maybe they shouldn't. But now that was a lawyer who was pretty upset and being pretty dramatic, but they were saying people are getting out of Dodge. Now that's a little way up here. My clients don't do that stuff. They're not that sophisticated, and most of them don't want to clear out of the country every time there's a tax increase. Alrighty. But yes, Ed, they could change the rules. But in general, if they change the rules, we call it grandfathering. Your old money is safe, your new money isn't. That's a general principle they run by. Okay, any other good questions?
I know I keep forgetting. So what's the number here, you know, postpone taking CPP,
I like this question.
take the RSP cost?
I answered that today.
Is it like 88 or 82? How old do you have to live before you break even?
Well, let's do the math real quick. I think it's 78.
Oh, really?
So, yeah, well, if you assume zero growth on it and you're spending it and whatever, but, yeah. Or no, 78 is your break-even point. Okay, I'll go back into the question here. So Canada Pension Plan is something that people who earn money as a proprietor or they're an employee, they get that amount taken from their check, put into the public pension, and they're supposed to get this pension, and it's designed to be paid to you at 65. So at age 65, I'm going to use this. Say you were, 65, not $65. Say you were supposed to get $100 a month. Or $100, I'll say $100 a year. And again, it's so that you can kind of see the percentages. You're allowed to take this early, though, at age 60. Oh, why wouldn't I take it at age 60? Well, because they'll only give you $64 of it. Well, that's okay. So from the age 60 to 65, if you take it early, you get $64 a year times 5 years is $320. At age 65, now this is the fun part. At age 65, you get your $64. But had you waited, you'd have gotten $100. So you're kind of $36 worse starting at the age of 65. So $36 worse. But that's okay. I got $320 up front. I'm worse this year at $36. So how many years is it going to be until my $36 that I'm worse every year eats up my $320 that I got ahead on? And I think that's about 8. No. I should have brought a calculator. I did. It's called my phone. Can you tell I was born before 1970? I used to carry a calculator. Now it's here in the phone. Isn't that great? 320 divided by 36, 8.888. You betcha. Approximately 9 years plus 65. That seems to be 74. So what that means is when you hit 74, you've collected, at that point, if you'd waited to 65 and gotten $100 a year, at 74 you've got how many $100? And at age 60 you've gotten the same amount. So you tell me, if you're going to live longer than 74, and I'm surprised it's 74 today. I think I must have missed something in the math here because it's usually 78. If you're going to live longer than that, let me know. And you shouldn't take it early. You should take it later. In fact, if you wait till 70, I think they'll give you 130. But there, you're losing $500, and you're only getting 30 extra. I believe it's 30. You're only getting 30 extra, so it's going to take 17 years from 70, 87 before you catch up. So our 90-year-olds that have passed away, they should have waited till 70 because they had gotten more money out of the government. But I'm not sure why the math today is 74. I think I've dropped a decimal place here. It's usually 74 to 78 is the cutoff point. That if you take early, you're going to regret it at age 74 to 78 because you're getting less out of them. But, you know, that's quantitative. That's bucks only. There's qualitative as well. We're a lot healthier between the age of 60 and 70 in general than we are between 70 and 80. And I've heard some people say, yep, I agree with you. If I live longer than 78, I'm losing money on the CPP. But I'm planning on doing my traveling now, and I want the cash flow now. Okay, you made a decision, an informed one. Now, is that the question you were asking? Oh, you also asked order of what you drain first.
Yeah, like, you know, yeah, like would you be better off taking, you know, so you postpone till 70, but you still need more money, so you got to take it out of your RSP to make up your deficit between your CPP and all that stuff.
That's right. And in fact, my order is usually first thing I like to see people drain in their retirement is their corporation. Then there are RSPs. Then they're open. And their last, their tax-free savings account. Apologize about the acronyms. Look them up in your notes to make sure you don't get lost. Corporations are pretty complicated things when you're retired, and they cost you a lot more because you've got a chartered accountant looking at them for over $2,000 a year to make sure the taxes are all being filed, and there's complications with it to make sure that everything's done right to comply with the government. So when people retire, I want them to get rid of their corporation first. Also, if they die with a corporation, that estate thing that we were doing gets way more complicated because they got your poor executor as your company to deal with as well. Second, I usually pick on the RSPs. Let's get the taxes over with while you're young. Then, that open account, member, if you happen to have something in an open account, use that next. And the last thing you want to use is your tax-free savings account. Because in these days, if you've used up all of this and now you're into your 80s and you need some money extra other than your Old Age Security Canada pension plan, then when you take money out of the tax-free savings account, you're not going to be penalized on the social services you're getting at that age. Yeah. So in general, now I've got some people that we've changed, we'll change this a little bit in accordance with their specific, and a lot of people don't have number one, but your small business guy does. And that's a big complication if you die with one of those. But after that, that's my opinion on the order. Let's see. Yeah. Any other questions? That's always a good one.
So if I'm going to die at 82 like all my relatives,
That's the number, is it? COD 82.
so I should probably be better for me to start taking my CPP pretty soon, right?
Well, theoretically, if you wait, you're going to beat them by living over 78. You'll get 4 years if you wait to 65.
But if I'm smart and I put my $64 into the tax-free savings account and invest it around 6%.
Yes, that skews it.
Again, right?
Yep. This used to be a slam dunk take early because before some rule changes, if you were taking your CPP, you didn't have to pay it in. And nowadays, CPP costs you north of $2,500, and your company has to match it $2,500, so you were saving $5,000 a year by taking your penalty. But they removed that penalty out, so, or they said, nah, if you are still working and earning, you can't get out of paying into it. The cool part is you can take early, and if you earn and pay for more CPP, they actually give you credit and up your CPP as you go too. So this gets kind of wacky.
Oh, really?
Yeah, it's called, there's another box. Next time you see a CPP slip for an aged relative, there's another box in that CPP slip that says point.
Aged relative, man.
Yeah, on the CPP slip, there's a spot for if you earned money after you started taking CPP and you paid into CPP some more, they give you a little bit more every year. And actually, I have not done his math, but I've heard from 3 of my colleagues that the rate of return on Canada Pension Plan, like a kind of your last contribution, I think they said it was 12% for an employee. But you have to live long enough to get your 12% back, and 6% for a self-employed. So if you put an extra $100 in, it's going to make a 12% difference as an employee, $12. But of course, you need 8 years or 9 years to get your $100 back. But at least you raised your CPP up by a bit. And the reason it's half for a self-employed is they're paying double that you are. But I've heard a few colleagues say that's kind of the magic number they've figured out. Haven't done the math myself, but wiser heads than I have told me that.
I kind of missed you though. What is it? Can you
Run by that again?
Yeah.
Let's see. Once you've paid into the CPP, if you pay any additional in, the money is like getting a 12% return on your investment.
And the only way you can
And,
Contributing,
yep,
right?
yep. Yep.
Okay, so I
Personally.
kick off at 82,
Yes, sir.
but Sheena lives to 95.
Good girl.
Like spousal, she gets like 50% of mine or 100% of hers, right? Whichever is greater.
Let's see. Well, she gets all of yours.
America.
She gets all of yours.
It's all mine.
Oh, no, you mean the Canada Pension Plan.
Yeah.
Right.
Yeah.
Yeah, she gets a widow's benefit. It's not what it looks like. What happens to her is hers gets bumped up to, they take a certain percentage of yours. I think it's like 60% actually. Maybe it's 50. But they bump up hers until she hits max. So this is what happened to my mother when my dad died at 69. She had worked from, my sister went to school and my mom got a job. Confused the heck out of me because I thought I knew what her job was. Oh, you learn really quick. And so she paid into CPP. And then my dad is 6 years older, and he retired at 65, and then mom retired at 60. And she took early, and he took on time. 4 years later, he passed away, and they said, okay, he was pretty well getting max. So he was getting 100% of it. And we were thinking, okay, well, 60% of that added on to hers should be good. But mom was already at about 70%, and she had the penalty because she took early. And so they bumped her up. I think the first check went up $2. So they did take from him and bumped her up to max, but she was so close to max that it didn't do much. Now, if your missus, though, had worked part-time, say, for, 30 years.
Yeah, she's a long way from max.
Yeah, let's say she's only getting a third of max. Well, then your money is going to push her up pretty close to maximum. But it does get, and maybe it'll put, maybe she'll get all of your, I think it's 60%, but whatever percent it is, she would get pushed up to her theoretical maximum.
But not more than what I would get.
Not more than you would get. That's right. Yep. Yeah, it's what is it? A survivor's pension, they call it. Yeah. Seen lots of that. It's not worth it for you to go.
Well, I got life insurance, so it definitely is worth it for me.
Okay, my only advice on life insurance is be more worth live than dead. But no, that's a good question on the workings of CPP there. But yeah, mom didn't get much because she was so close to max already that with dad, it would have been better if he had lived. Yeah, there's one other thing here we haven't talked about that's also retirement, is old age security. That was that second number I put down that's about $8,000 a year. It's shy of 8. It's like 7,800 or something like that. If your income goes above about 75,000, they start, for every dollar over 75,000 they take, give or take, they take 15% of that away. So we call that clawback. And so what I've got out there is, say I have a senior with a couple rental properties that are paid for, and they've got they've got a pension from somewhere, and they're sitting at $60,000 worth of income, and all of a sudden out of their RSP, they're forced to take $30,000 or something like that. Well, that all of a sudden eats into what they get for old age security, because old age security is for poor to modest old people, not for rich old people or for high income old people. They don't have to be rich. They just have to be high income, and there is a difference. So we call that clawback, and for many people, it's not a worry. For the farmer, it's a worry, because farmers' income goes like this until they retire, and then it goes like this as they sell everything. And for a few years, they lose the old age security, and they whine more about that sometimes, losing the $8,000 a year than the $50,000 in taxes they're now paying. And then it drops back down, and they start collecting it again. But some of the hardest seniors are the ones that end up in that, they've worked well, they've saved well, they've invested well, and their income's sitting at $75,000 a year, and then they get the old age security and lose a bunch of it. I think that's a way better position to be in than getting $10,000 for your retirement and keeping the whole thing. That's personal, but that's why this RSP. Sometimes I've had people say, well, I'm 65, I'll leave off on the old age security and the Canada Pension Plan, and I'll drain my RSPs over the next 6 years. pay all the taxes on them, and then I'll collect full Canada pension plan with the bonus and full old age security with the bonus at age 72.
Yeah, that's what I was thinking too, but you're saying it's better for me to do it at 60.
Let's see, what math, the math we did, how old were you when we,
82.
82? Oh man, don't they know you? Yeah, you'd break even. I had one of again, the tax advisors, they say in about 3/4 of the circumstances, you should take later than earlier. So your idea isn't too bad. You know, drain the RSPs first. You're draining the RSPs first, and you are pushing off these to get your money later, and hopefully you're living long enough for that to make the difference. A lot of people are taking this, and then it takes them longer to drain their RSPs. They're spreading it out. Yeah, maybe you're, and that's why this has got to be tailored a little bit. Like, you know, what you thinking? It's like, oh, okay, so you want the big bonuses at 70 and 72. So, and it also depends where you start with your RSPs. If you got $1 million in RSPs, it's going to be pretty hard to drain those puppies over 5 years, and good on you.
I bet you I could do it.
Right on. Good man. You know, but you know, what if you didn't do RSPs? What if, well, my farmers, should I buy an RSP? It's like, or should you pay down debt on your land? You know, to them, their retirement savings is locked up in their land and their grain that they haven't delivered yet. So a little different answer for them. And I actually had again, one of my colleagues, he did some number crunching, and he said, if you're approaching 55 and you got 10 years to go to 65 and you got a mortgage, should you pay that mortgage off by the time you're 65? Or should you put that money that it take to pay the mortgage off and put it into your RSP instead, and then keep paying a mortgage into your retirement? And he crunched the numbers, and he actually came out with that you should pay the mortgage, stop putting in the RSP and get rid of the mortgage. Because when you're paying your mortgage payments, you're drawing out of your RSPs, and you're killing the extra goodies that they would give an old person with low income. He said that was the difference there. And you know, I got to tell you, philosophically, I don't want you retiring with debt. Because you know, it's hard enough to keep up with debt when you're working, much less than when you don't want to work anymore. So I'd like you to clean up that debt. Get rid of it, say goodbye to it, kiss it. It's like, thanks for the good times, and you help. Maybe you needed a little bit of it once upon a time to get through some stuff. But cut those strings someday and step forward in a brave new world. So, can I confuse you with any other answers? Ed, are you a U.S. citizen as well? No. Okay. Are you still filing your U.S. tax returns every year, young lady? Okay, good. You are in the upper 25% of tax-savvy individuals in Canada. Congratulations. You are above the pack. Yeah. There are a few of your fellow citizens that have gotten themselves in big trouble by not keeping up with their tax filings. Because in Canada, you're going to hear the word residency. At the beginning of our chat, Jeff said, hey, you know, where are you resident when you die? If you died in Cuba, you know, is that all of a sudden where you're resident? It's like, no, your home was in Alberta. Even though you died somewhere else, they consider your estate lives in Alberta. Canada will tax you if you're a resident, if you're here. The US will tax you if you're a citizen. And it's a different flavor. Yeah, there's only 2 countries in the world that do it. US and I think Antigua. And I don't even know where Antigua is. And I'd like to see them I'd like to see Antigua trying to enforce it. But Canada is so tied in with the US, economically, geographically. Our banks, who did very smart things like expand into the US, now on Canadian type things have us disclose with our bank accounts where we were born, because that Canadian banks give information to the IRS on where you were born, because they're looking for the draft dodgers. They're looking for the US citizens here that aren't filing every year.
Yeah, I have to be careful because I'm not a resident yet.
Here?
Here.
Okay,
So we still have to file all that.
right on.
So I'm still an American citizen and I have a company over there.
Uh-huh.
And so I have to do all my bookkeeping because it was very difficult to find deal with everything.
Yes.
So I'm doing my own bookkeeping, but I do have an accountant that does my taxes.
Good.
And then I do have an account that I'm going to file with him so I can spend Canadian dollars.
Yep. Yeah,
And
you're reporting that though to the IRS on the.
well, I don't have to as long as it doesn't go above $10,000.
Okay,
So
good.
we're careful to make sure that it all goes into his savings.
Not yours.
Not we don't have to do a joint savings.
Yeah.
So that, and it's right because it's just I need to be able to spend money here.
Yeah.
Without having to.
Do you have any access to it? No, I'm going to try and worry you here. Do you have this access? You don't have a debit card that gets into his savings?
My checking, but not the savings.
Good.
Separate.
Because they sometimes think it may be his name on the account, but if you got the debit card and the password, it's your account too.
Yeah.
So I've heard.
So we have to make sure they're complete.
Yeah. Yeah.
Yeah, because how else, I have no other way to spend money here.
Exactly. No, and see, there's practical aspects, right? And it's not the end of the world. We like to be all dramatic. Ooh, U.S. citizen, ho ho. You're filing your taxes, we're done. There's, yeah. Yeah. It's just that some people, actually, it's kind of funny. A lot of U.S. citizens come up here and they think like Canadians already. Oh, I'm not in the States. I don't have to file a tax return. They don't understand their own system. It's like, oh, okay. And for a long time, the IRS didn't care. But you notice that the government there likes to spend more than they live on. And so, and what are they going to do? Tax people who vote or tax people who don't vote? La, la, la. Yeah, it's kind of funny. They said that 1 in 30 Canadians are actually Americans, American citizens somehow. And I went, well, I'm doing 600 tax returns, but that suggests there's 20 Americans in there somewhere. And I only know of, I think I knew about 3 or 4. 4. Yeah, the other 16 started coming out of the woodwork very slowly as noise got louder and louder. Yeah, but, and then one of them stopped coming to me because I think he does his own taxes now, which is a good way of him, I think he thinks he's staying hidden, but, you know, that's okay. I don't file US taxes. I actually I used to do that for one person, and I was just doing it by route and hoping, you know, and nowadays, to file a U.S. tax return, you have to have a tax filer number. You have to register with the IRS, and they keep track of your number, you know, how your tax returns did versus their audits to see how close. And if you're way out, you're going to lose your number. Yeah. There's talk about doing that in Canada the odd time, but it's not as, again, big Billy Goat Gruff and little Billy Goat Gruff. Ours is littler.
I have a question. I don't
Yeah.
actually earn any income yet because I don't have
Mhm.
work for me.
Yeah.
So when I finally do, if I earn income here,
Mhm.
what am I supposed to do about food?
Guess what?
Income in the US.
Oh, that's a good question, actually. All right, if you're a resident in Canada, whether you're a citizen or not, if you are a resident in Canada, your bank accounts are here, your health care is here, your family is here, like you're probably skirting the line. You are required to report your global or your worldly income. They call it worldly. So all of your stuff in the States is supposed to be reported in Canada as well. Now, one thing that happens is you want to keep filing your US tax return on your US income, because if you earn $100 in the States and you pay $25 to Miami and, Florida, Miami's not the state, Florida and the feds, they take that $100 in Canada and they tax you $30 here. Welcome to Canada. Wait a minute, that's $55, but they give you credit for the $25 that you paid down there. But they only give you that credit if you can show a transcript paying those taxes or a receipt from the IRS. And I've had to do that for a couple clients, and that is a pain in the butt. But basically, you get to report your worldwide income here, and if some of it is US based, you're going to pay some taxes in the States on it, and you'll get a little credit for it here and pay the difference. So that's the sweet way of doing it. It'll be complicated, but the software takes care of it.
Filing everything now. We're in the process of like finishing citizenship stuff.
Cool. Are you going dual? Like you'll keep your US citizen or?
Do residency, permanent residency first.
Okay.
Years.
Yeah, okay. Yeah, see, I don't know all that immigration stuff. But I do know that you can be resident in Canada without being a citizen. That's for sure. And cool. Yeah. My best story is a family came up to do sheep farming, ended up in cattle eventually, and they came up in like the early 70s or late 60s, and they stopped filing at that point. And of course, they disappeared into the north, no one ever worried again. They amassed millions of dollars and retired in Kamloops and Kelowna, and then they heard that IRS was actually knocking on doors in Kelowna, and they actually went to a tax attorney in Canada that dealt with cross-border issues, and they reported kind of their lifetime earnings a little bit, paid $250,000 in tax to the IRS, and now they're clear. But, you know, the IRS kind of just took, you know, they had to file 10 years worth of returns and pay the penalties on those 10 years, and then they were good. But, you know, they've got a clear conscience, though. Yeah. I could not give them this advice, but my thought was to shoot, shovel, and shut up. But, you know, the guy who would be on the hook there is their executor. And I didn't know if I was on the will or not, so it wasn't a good advice to give.
I had an American friend who said they lost their citizenship. They found it was just cheaper to
Renounce.
Canadians.
Yep.
That was about, and they weren't the only ones. There was a whole slug of Americans
Yeah.
5 years ago that walked.
The saddest thing is I had one of my 4 that was actually doing his taxes every year faithfully in the United States. He was a Republican before Obama got in, and once Obama got in, he said, "Oh, nope, this is not going the way I want it," and he renounced then. he was worried. And so yeah, you know, it was kind of funny that the one guy that was doing it right renounced. And the people that weren't doing it right still haven't come out.
And my friend told me, though, to file IRS was so expensive,
Mm-hmm.
it was so complicated that he felt it wasn't worth the citizenship anymore.
Fair enough, and I think he's right in some, like if your return's pretty, you know, it's kind of funny. If your return's really simple, are you paying an extra $1,000 a year to file your taxes? Hopefully not, but it might be. And my guy, though, he had like, you know, he had capital invested at $2 million plus, so it was worth it for him to, plus he owned property in the US still with some siblings, so it was worth it for him to pay the other $2,500. Yeah.
Is that the one? Well, you can't say.
Yeah, can't say. Can't say unless you're a judge. Yeah. Yeah, but yeah, it was a good stead. But actually, when he renounced, he still had property in the States, but it's getting taken care of different now. He chose to renounce. And that's a big deal. You go to the consulate in Calgary, and they get a little mad at you if you want to renounce. They poo-poo it. They get a little personally insulted, it seems. You know.
But don't you pay more taxes here?
Yeah, but
A lot more?
not a lot more. Actually, you know what? I don't know personally, but I think that if you take our taxes plus what you pay in health care,
We calculated it, you guys pay a lot more.
you pay a lot more versus taxes plus health care there. I'm thinking it should be, yeah, health insurance. Yeah, the private health insurance or something to get equivalent care.
Pre-Obamacare,
Yeah,
I used to pay a lot less.
okay.
Because of Obamacare, I got worse quality health insurance.
For more expensive?
More options, because before it was private and there were competitors.
Yeah.
So I was paying X amount, but then post-Obamacare I was paying almost double. I got a credit that I had to pay a fee on my taxes, so I ended up having to pay more. So it wasn't, I was literally getting half of that.
Yeah.
Right, like, because I had to pay the other half back at the end of the year. And then my insurance was horrible, and then none of my doctors accepted
The new.
Obamacare.
Okay.
And I had no options because I was self-employed.
Right.
So it was awful. It's been a mess, I think.
Yeah.
personally.
See, I
I'm a
think
self-employed person.
that's what I think a lot of Canadians who like the traditional, we just pay the taxes to the government and then we pay a little bit extra depending on use. I think that's why we feel a little safer. Ours is safer, maybe more expensive, but safer. I've heard statistics, though, that say that we spend less of our gross domestic product on it. Overall, I'm sure individual it can vary. And actually, you know what I think the reason is that we pay less in GDP for gross domestic product than, say, the Americans do on it? And that's because when a government builds a hospital, when it falls down, they just raise taxes and build another one. If that hospital is privately owned, they have to charge you enough to make a profit to build another building or to keep the building up. like it's a return on capital would be like a, forgive my old economics stuff, but you gotta, if you're in for profit, you gotta be able to replace your assets. The government doesn't necessarily replace their assets, they repurpose them or whatever, or they don't have to. So they just charge enough to kind of keep the maintenance going, whereas, as I say, a business has got to replace the factory someday.
And it's actually, I had to deal with the medical system here,
Mhm.
and I had to deal with it over there, and it's apparent. Like that, you pay bare minimum to keep it up.
Yeah.
Like I went, oh.
Yeah. And so now, which side of the fence should we be?
I'd rather be over there 10 times over, because it's like I have an appointment for an emergency thing booked in December.
Yep.
And like in Miami, I would go to my doctor's office, and in the doctor's office get it resolved right there.
Yep.
I have to wait until December.
Yep.
And it's like shocking. One of my friends is a nurse, and I called her, and she was like, "No, you can't. No.
No,
Like, it's
push harder."
impossible." That's like if she literally mind blown.
Yep.
She's like, "That's ridiculous that a hospital can't do that." Like so.
Yep. You know what? Negotiating the system is another thing.
Yeah.
Yeah,
10
it's
times over,
tough.
I'd rather be there medically, but you pay a little more fine.
Yeah, and you know what? There's a difference between the insured and non-insured too.
Right.
If you're insured and insurable, I think it's a great system. My wife severed her tendon down there, and she was the only one in the party that she was with that had health insurance, and she saw a microsurgeon that day.
Yeah.
Whereas if you'd done it in Grand Prairie, we don't have a microsurgeon. You'd be 3 days later in Edmonton, and I actually had a client with the exact same injury, and she's got a partially numb finger.
Yep.
My wife has nothing.
10 times over.
Yep.
Over there.
But sometimes I do wonder if it's because we're remote too.
Yeah.
Like maybe if you were in Calgary or Vancouver or Toronto or Ottawa, Ottawa's got great social services for some reason.
You know what? It's shocking to me
Mhm.
and mind-blowing and sad.
Yep,
It's
we're on the
sad.
frontier.
It's so sad that I had that experience here.
Yeah.
Because it's upsetting. I'm actually very mad.
Yep.
Still mad about the situation, right? Because it's but had I come from another country, this would have been so much nicer.
Yeah.
So
Yeah. It's tough.
yeah.
Tough to know. Which is the best way to go?
If I had a choice, I'd pick it. Not to be offensive.
Nope.
Really.
Nope.
Not at all.
No. There's pluses and minuses to both systems, that's for sure. And I'm pretty sure the media loves to inflame.
Yeah. Yeah.
We're going to only hear the worst, and we're only going to hear the worst.
That's what upsets me too, because I hear so many bad things about the medical system. I'm like, are you guys kidding me? Like, do you realize what the medical system here is like?
Mhm.
So it's just little things like that where I just like the reality of what I hear in the news
Yeah.
versus what I know. The people because I know people that are poor,
Mhm.
but if the hospitals have paid everything for them.
Yeah.
So they've gotten in emergency surgery, paid zero, because they're Medicaid.
Are you kidding? The news tells us that they die on the street.
That's what I've always heard, and it's never happened, and I know this. So it's just interesting what Canada sees
Yeah.
versus like the reality.
Yep. I always have to remind myself that I think the news is right until I hear them talk about taxes and accounting. And then I wonder, that's only half true. But I think everything else they said was true.
Yeah.
I'm thinking we're hearing some half-truths all over. But so, any other questions?
Sorry.
Or are we good for now?